Paul Durso here again, and what I want to do today is go over a LIRP illustration using Simplicitree. This is specifically for your study group members out there, and what I want to do is use an example from Joe D'Amico. Okay, Joe D'Amico is a 52-year-old soon-to-be retiree, wants to retire, well, not too soon, in 14 years. When he turns 66, he's got about $810,000 of assets. It's all held at TD Ameritrade. This example that I'm going to go over with you today actually came from a live case that we used with one of our Simplicitree users, and we came up with this together. I do quite a bit of consulting, and this individual called me and said, hey, I want to do this sort of LIRP, but I don't really know how to set up the plan. And I'm going to show you exactly how we set up the plan, and the benefits back to the client were pretty amazing. It actually started to get me thinking on how different ways that I can use LIRP illustrations in the system to illustrate the benefit. Okay, so we got a 52-year-old retiring in 14 years. 66 is when he wants to retire. He wants to live on $125,000 a year. Now, to put that into perspective, he only has $810,000 today, and if we look into this future, he does not have any residual income. All he has to count on is Social Security. Okay? Zero pension, zero rentals, all he has is Social Security. How in the world are we going to do that? A few other things that we want to look at. 100% of their assets are above ground. You understand what that means. There's just no protection. All $810,000 of their assets are above ground. Their principal tax concern is 99%. That means 800 of his $810,000 are 100% taxable when he hits retirement. So we've got a whole lot of risk, we got a lot of taxation, and we have a huge target of income. His cumulative income need is 18. He has 18% accounted for his future income by his Social Security. The other 82% has to be generated by his asset base. He's going to need to grow his above and below ground assets, his total asset, investable assets, by 6.25% to ensure that he does not run out of money. If he wants to keep the same asset base, he has to have an average of about a 6.5%, which is kind of interesting how close those rates of returns are. And then if he wants to leave a legacy, he's got to return over 8% a year to increase his $800,000 over what it is today and live on that $125,000 a year. He's going to save $6,000 of savings per year into his 401k or Roth. And then when he retires, again, he's only got $25,000 of Social Security income. He wants to live on $125,000, which means his asset base has to generate well over $100,000 of retirement income for the rest of his life and keep up with the cost of inflation and taxation. So how did we set up this case? So we're going to go over here to the investment planning tab. Now, my custodian's Charles Schwab. The assets are held at TD Ameritrade. So the first thing I'm going to do is I'm going to show him moving his assets over to Charles Schwab. And this is one of the things that I always like to tell my advisors or advisors that use this system. Don't be afraid right in front of them to show, rolling over a 401k, even if it's just a prospect, to saying, hey, we use this custodian. What I'm going to do is I'm going to recommend we roll this over. So we're going to sell it out of your 401k, move it to a custodian, we're going to roll it into an IRA. Now, in this particular case, of the $800,000 that they have in retirement assets, we divided it into 2 IRAs. Now, I'm not going to go into a lot of the math on how we came up with this. We worked in detail, myself and this other advisor, on how to divide the $800,000. I can tell you $225,000 is in one IRA, the $575,000 is in the other, and basically what that means is when it's all said and done, we did a 10-year pay into this plan, and we know of the $800,000 after 10 years plus dividends, because we're investing this into a dividend portfolio, we're going to have $575,000 that literally are going to be left into the dividend account. The other 225 plus a whole lot more is going to be into the life insurance policy, the LIRP, which means that we have $10,000 left into their Roth. So we're organizing it that way. There's actually going to be more money that's going to be made, but we're not even going to show it. We're going to show zero growth over the next 10 years on money that's going to be in the dividend account or any extra payments that are going into the life policy. We're just not even going to show it for literally conservative reasons. And if we scroll down here, what we're going to do is we're going to show the amount of dividend income that their Charles Schwab dividend account is going to do. And then we're going to come all the way down here to their life insurance right here. And that policy estimated 14 years from now based on the 10-year pay-in. I don't offhand remember the exact premium, but it's significant. It was like $70,000 a year we were going to put into that policy. And it's roughly going to pay in 14 years about $110,000 of income back to the client. And that illustration was provided by yours truly, Ward Bell and Associates, or Bell and Associates. Now, if we look over here to the investment plan, a couple things I want to show you. Now, remember, when they came in, they had 100% of their assets above ground. They had a 99% principal tax concern. A lot of discussion happened around this and this, okay? And then the last thing, they had 82% of nest egg income need. They have to generate over $100,000 of retirement income. Fast forward to the value we're bringing them. First, right off the bat, we're going to show about 30% of their assets going below ground into the LIRP strategy. In doing that, we're going to take their principal tax concern from 99%, and we're going to drop that to 71, almost a 30% decrease of principal tax concern. That is significant in value. And the result of our planning, not only are we going to generate them the 82%, but there's a 24% buffer. They don't have to worry about running out of money. Remember, they needed 6.24% rate of return. Now with our plan, they don't even need to make anything. The rate of return, the retirement rate is 0. So we drop that. If they never made another dime of interest on their investments, the LIRP aside, they won't need anything from anybody. They will not run out of money. The LIRP obviously still has to earn its internal rate of return, which we all know those historical rates and how strong they are based on where the cap rates are. We're going to be generating them about $160,000 of retirement income plus Social Security. He could live on about $180,000 of retirement income. Remember, starting at $800,000, this is what efficient planning does. And the best part about it, we're showing them right in the system exactly the benefits of those recommendations. This is our value proposition. We don't have to worry about, why are you recommending this or where's this recommendation coming from? They're going to see right in the system exactly the benefits displayed very simply and easy to understand. How we put 30% of their assets below ground, how we reduced their principal tax concern, and at the same time dealt with their cumulative income need by reducing all the rates of return across the board because of the effectiveness of the investment recommendation. So this is just one example, a one-pager, Charles. This is our one-pager literally flushed out through Simplicitree, and the power of that LIRP displayed through Simplicitree right back to the client. This is how we've been able to get so many different sales through this strategy. And there's a lot of other strategies we use, which we're going to show in further videos.